Today we're in London, and as we were walking around, it made me want to do a video and talk about the differences between investing in the north and investing in the south. So today, what we're going to do is we're going to take two comparisons. If you're sat there with Exeter Bank and you're looking to invest in property and you undecided whether to invest up north or down south, then by the end of today, you will learn exactly what each option offers you. So, without going into too much detail about the differences and why we invest in property and the different areas, I want to talk about two main focuses. One, how far does your money go and what's the plan? And number two, the capital growth as well, because I think that's quite important. So, I'm going to share my screen with you. We're going to look at the capital growth, then we're going to take two properties, one which we've actually sourced onto an investor, so that completes very soon, and another one that we've just had a quick look at in London, on the outskirts, actually in Uxbridge, which is where I'm from. So it's in London, so we can have a look at the comparison in numbers, how far it gets you, what it gets you, and then the business plan as well. So let's jump into the screen. First thing I want to talk about is the capital growth. So what this is Savills forecast, to one of the UK's biggest estate agents. I think they actually are the UK's biggest estate agency, and they've got the regional house price forecast from 2026 to 2030. As you can see, this year is going to be quite a comfortable, quite a stagnant year, and then from next year, from 2027, we're going to see a real influx in prices, which is fantastic. And then hopefully that will continue. However, and this is what we really want to focus on, because if we're investing for long term as well as cash flow, but long term nonetheless, then you'll notice that at the top you've got Yorkshire and Humberside, very similar to North East, sitting in just under 30% capital growth. So if you own a portfolio valued at £1 million over the next 5 years, you will create £300,000 of equity growth, which is a lot of money, or 288,000. However, if you're owning in London, that is down at 13.6%. So the difference there, if we had £1 million up north, that would go up just under £300,000 in value. If we have a property in London or a portfolio valued at £1 million, that would go up 136,000. It's more than double. So straight away, when we're talking capital growth long term, and a saying that I say all the time is zoom out to zoom in. If we were to zoom out on building a portfolio over time, capital growth, especially in the next 5 years, showcases such a huge disparity between the two. So North is winning so far. Cool. Right, now let's compare two different properties. So I've picked up one that we've got in Castleford, which is in the north. It's just outside Leeds in West Yorkshire. So what we're going to do here is going to compare two 3-bed terrace properties, very similar, both online. One of them, this is sold. We have this property, this completes very soon. The one in Uxbridge is one that I've just had a quick look at, found a bit of an average and picked that one as well. So I want to go through the numbers of the north first of all. What you'll notice with this, and this is a spreadsheet we use in-house, this showcases all the numbers. This is a buy, refurbish, refinance spreadsheet. So what that means is the aim of this property is to buy it. It's to spend a little bit of money on the refurb. This property that I've picked needs very little. So what we've done here is we've been able to secure it at a better price because the refurb isn't as big. So we're adding value to the purchase, not through the refurb on this specifically. And then we would refinance this in the future to pull some money back out of the deal into our pockets to go on to the next one. So if we quickly run through, we'll go through the property first. So as you can see, it's a 3-bed terrace property. It has got a bit of a drive. It's got a lovely kitchen at the moment. We might give it a quick paint due to the colours, but it's a lovely kitchen nonetheless. That is a living room. Then we've got a spare downstairs toilet, and then we have 3 quite comfortably, we have 3 good sized bedrooms upstairs as well. So that is a quick, and then that's the bathroom, of course. So this is a good property. It needs very minimal work. We've budgeted a couple of £1,000 just to give it a quick paint in the kitchen, maybe just to give the outside a bit of a tidy up, just to help with the drive and etc. So there's very little needed. As I say, we've focused on the purchase here. So if we look at the numbers, we have this secured at £135,000. We are buying it with a mortgage. So at 25% deposit, that's £33,750. So our initial mortgage is £101,250. The rental income of this property is around £950. The refurbishment, as I say, is around 2.5, including VAT, and the market value is 150. So if we add all the buying costs together, we add the deposit, and then we add the slight refurb, our overall cost on this project to own the property is £52,650. The goal of this is to refinance in due course on a higher mortgage of the 150. So we have a new mortgage of just under 115,000, pay off the old mortgage, which means we would get just over £10,000 back in our pocket. So the money left in this deal is 421 with a 37.5 grand equity and a net rental cash flow of £358. So the annual income, just over £4,000. The money left in the deal is 41, which means our return on capital employed or return on investment is 10.38%. Two things I want to focus on with this. Number one being the return, so just over 10%. And also bear in mind that that is on the income alone. So that isn't even including the capital growth on the market value over the next 5, 10, 20 years. Doesn't include the rental increases over time as well. So a 10% return on the income versus money left in the deal is very, very strong. The second thing that I want to focus on is the total cash outlay. This deal costs us £52,000. So the entry point to invest up north, as we'll find out in 2 seconds or in not very long, is minimal compared. So if we're sat there with 50, we could just about get into this deal, maybe need a slightly bit more, all the way up to 150, 200, we could buy multiple of these deals. And that's where investing in property really starts to grow because of the compound effect. That's for another video. Today we're just comparing the north versus the south. So that is a north property deal. So if you want to screenshot that, have a look at that. That are all the numbers, and these are all numbers that we have worked towards and a deal that we have actually done. So these aren't pie in the sky, these are real life numbers. What I want to move to is the London property. So this is one, as I say, that I've looked in Uxbridge. I've done some research, not a huge amount. So I've used a lot of the numbers that Property Data have given me. I'll put a link in the description if you want to download Property Data. And what it does is it helps find and source properties. It helps value properties. It gives you comparables. Again, we'll do a video on that another time, but it's definitely worth downloading. I believe you get a free trial as well, so it's worth utilising that. So this is, as I say, in Uxbridge. This is up at £475,000 at the moment. I'm going to, even though it says offers in excess of, I'm going to put in our numbers that we've got a slight discount on this, the same discount that we've got on this property as well, so around £15,000. Then what I'm going to do is I'm going to use the average 3-bed asking for rent as well. Okay. Another point that I quickly want to notice is you can see that the last 3-year capital growth has not really moved compared to a very small 3-year capital growth in the northern area. Bear in mind that's been in a market that's had its ups and downs, and the economy has most certainly had an impact on that as well. So if we have a quick look at this, it's a 3-bed terrace property. It's very similar to the other one, although this probably needs a little bit of TLC. So I would say like the kitchen probably needs to be a new one put in. The rest of it probably spruced up on the painting, maybe some new flooring upstairs because of the beds and it'll be worn. But what we'll do, and probably a new bathroom. If you are watching this is your house, no offence to any of that, of course. So what we'll do is on the analyzer in London is I've put on around a 10 plus VAT. Again, just to notice with that is using the northern prices. If you're going to put new bathroom, new kitchen, paint and decorating, you're probably quite a bit more than that. But I'm going to give benefit of the doubt, okay? So, as I say, 15 grand, we've got this offer accepted. We're buying this for 460. Property Data's coming out around 500 for what the GDV should be. So it's around £500,000. The rental income, 2,100. The refurb, £12,000, which means solicitors and ILA at 1,700. Broken survey, again, we're using very similar figures. You'll notice the stamp duty is very high on this. The stamp duty on this property alone is over half of the cash that we need to buy the deal in the north, which is crazy when you say that. So you're putting over half of what you would to buy a house up north over to the tax man from day one. Again, crazy to even think like that. Just to sum up the numbers, deposit, 25% of the 460, 115,000. The initial mortgage, which would be taken out as 345. The buying cost of 38,100, which is majority stamp duty. And then the refurb cost around 12 grand. What you'll notice here, and the big one, is £165,000 you will need to buy this one property. So if we're going to be fair and compare, this Castleford property, we'd be doing that 3 times over. So everything you're seeing there in terms of the money back, times that by 3. In terms of the equity, times that by 3, if we're being fair on the comparisons. However, let's say we're still making these, and to be honest, it's actually just less than that. You've still got 10 grand change. So we purchase this property, we then look to refinance it onto a new mortgage at the £500,000. So we'd be pulling out around £30,000 due to the increase in value, which means our money left in the deal is £135,000. So if we were to look at the comparison in the numbers, the Castleford deal, the ROCE, the ROI, the return on investment, 10.38. The return on investment in London on the income alone is 2.96. So you're making less cash flow. So bear that in mind, because I get a lot of investors that say they want to invest in London because the rent is higher, you're making more cash flow. That's incorrect. So the cash flow on this is less, and it's costing you £135,000 than it would for £40,000 up north. It's already less. Never mind that you could do it 3 times over. Now what we're going to do is we're going to compare the cash flow from the north and the south. over the 5-year period. So I've worked out a capital growth. We now want to look at cash flow. So what we're going to do is we're going to have a look at the annual rent times by the 3, because remember, for the £160,000 that we've got, we can buy 1 down south, we can buy 3 up north. So that's what we're going to compare. Then what we're going to do is we're going to times that by the 5 years. That leaves us with £64,000. So that is the net rental income over 5 years for using that £160,000 for 3 properties up north. If we move over to London, what we've got here is we've got 1 annual income times by the 5 years, which is £20,000. So again, when we're comparing the north and the south for capital growth, the north is winning quite comfortably by 2 times, by the way. When we're comparing cash flow north and south, the north is winning on these examples 3 times. And this is only using a 5-year period. If we were to look even further and further and further, these numbers create a bigger and bigger gap. So if we're investing for the long term, we can see that if we're looking in the north, we are winning pretty much every single component. So that is a comparison between purchasing in the north or investing in the north in property compared to investing in south and in property there. Now, I appreciate that some investors will respond saying they don't have access to the north, they don't have the network, the power team, whomever that might be. What we do as a service is we help investors invest in the north. So we have the power team, we have the network, we know the good streets from the bad streets, and we understand the investment strategy to be able to grow a portfolio over time. So if you're sat there, you're watching this, you've wanted to understand where to invest, whether the north or the south, and you've realised potentially that the north is the better strategically to invest in, I'll put a link in the description. Click on that. What you can do is you can speak to one of the team. We can have a conversation to understand the best strategy for you, depending on your budget, depending on your goals, and depending on what you're wanting to achieve. And then through that, we can understand and build a bespoke business plan for you, so we can envision what the next year, next 5, and next 10 years look like. Click on the link, book a call in with our team, and we can have a chat to understand what works best for you. And of course, like, subscribe, and all that bollocks.